Hello, everyone. This is Greg Patterson, CEO of the Advisor Group, and welcome to our quarterly context for the second quarter of 2020. Sometimes I get a kick out of saying 2020 because it seems like in a year like that, we should have perfect vision of the future, right? Seems like it's just the reverse this year, as for lots of reasons that you can expect. These quarterly context webinars are designed to provide helpful perspective for normal and challenging times about the economy and markets and investor behavior to help clients and friends of the advisory group make better informed decisions and feel more comfortable through knowledge regarding the environment and maybe a little more about how to think about a few things. I'm sure there's a lot we could learn from you as well, and we always look forward to that. So let's get going. As always, we like to remind everyone of the importance of focusing on what you can control and that matters. We'll go into a little more detail later about that, but always a good reminder, especially in periods of high uncertainty. We are very happy to hear that from clients we speak with in general that having a plan and having a strategy is giving them a lot of peace of mind and even in these challenging times. So we're happy about that because that is our goal. In terms of the 4 quadrants here, also helpful and sometimes worth writing out and maybe keeping one of these in your back pocket on maybe a personal retreat day and writing down the things that might have changed for you in terms of what's important to you short-term and long-term and what's really critical and absolutely necessary versus what is required and absolutely needed versus not. And those things can evolve over time. So let's take a look at the chart here. You can see the obvious news is that during the last year or 2 quarters, been a lot of change with the market hitting all-time high, the coronavirus health concern becoming an economic crisis, and then the subsequent, at least very strong, surprisingly strong market recovery, but without the economic recovery yet. So the markets are anticipating the future, and we'll talk more about that. Won't really go into a lot of the details of the news here. You can peruse that on your own, but you can see here, even if it's a small chart, this is the coronavirus global heat map update. You can just see that the red is all over the globe, concentrated in high population areas, and in particular in the US. Second quarter was a welcomed but maybe overly optimistic quarter in terms of markets. The US market about 22%, international 15%, emerging markets 18%, global real estate 11%, and the bond market up 3 and 2, essentially for the U.S. and global. For 1 year, that means despite having the one of the fastest and steepest markets drops ever in the first quarter, looking a year back, U.S. stock market is up and is up essentially only 0.5% off the expected long-term return. International stocks are still down, but are considered a considerably more attractive value relative to U.S. stocks, which are considered to be generally maybe overvalued relative to historical norms. And there are interesting debates you can have about that. So that quarter was the best quarter since 1998 for U.S. stocks. In addition, the NASDAQ hit an all-time high towards the beginning of June and has had subsequent highs since. and is up about 40% from the lows, and other stock indexes are up even more than that. The S&P, some of the big stocks within the S&P, what are some called the FAMG stocks, the Facebook, Amazon, Apple, Microsoft, Google, accounted for about a third of the return of the S&P. So if you're wondering where that's coming from, the rest of the stocks, while doing reasonably well in this recovery, were hit harder on the way down and have not come up quite as much on the way back. And collectively, that group of 5 stocks had a 35% return for the quarter, so considerably above the overall market average. If you were to take those stocks out of the indexes, the US stock market might look a lot more like the rest of the world, like international stocks, for example, which have been more tepid in their returns. So let's take a look at our typical line charts where we've attached the coronavirus crisis to the end of the global financial crisis and recovery market. And we can see that at the end of the first quarter, it was right around, still, even at the bottom of that market, essentially right at or just above the next best recovery of the 4 worst market crashes, which was the oil and financial crisis of the 70s. Now it's subsequently bounced up quite a bit and considerably higher levels. This is on an inflation-adjusted basis, and this top chart it would still be behind that market on a pre- and inflation-adjusted basis, but the inflation-adjusted basis is more telling because those are the returns you can actually use versus those that have been eroded by inflation. The 70s had a much higher inflation period. So let's take a look at a few things here. Second quarter was a wild ride back up the roller coaster. But the big questions are, as to what degree is there a disconnect between the markets and the economy? And the phrase we're using a lot now is, don't take your seatbelts off quite yet, because just because the markets bounce back doesn't mean there isn't volatility ahead. And many economists are concerned about the difference between the market and the economy. The numbers are surprising, again, being, with the S&P being only down 6% from the recent or the prior high, whereas the tech bubble and global financial crisis had their subsequent peaks, troughs around the 50% negative mark. So we did hit a low. It's back up, but something seems a little bit too easy about this so far. Technically, the way bear markets are measured, that means with this market recovery so far, that was the shortest bear market ever. And some markets have fully recovered in terms of the market, again, not necessarily the economy. And another way to think about this is that we just got 4 to 6 years of normal equity returns, normal stock market returns, in less than 2 months. But the risk hasn't gone away yet. So that may mean that there could be a period of volatility or a period of years following of weaker returns if some of the futures returns have been moved into the present, so to speak. So why is the stock market so far ahead of itself then? Or if it is accurately predicting the future, what is it relying on right now? Well, ultimately, it's expecting that the economy will thread the needle, that the current virus spike, which actually has picked up speed since the end of the second quarter, when it was initially picking up, the projection was that it wouldn't be as bad. Now it's getting worse. The market is hoping that there won't even be a material second wave in the fall when the normal flu season comes around. Huge government stimulus, as we talked about before, to the tune of $3 trillion plus. There's big hopes for vaccine and that it might be produced, or that they might be produced, because there seem to be 3 major players that are all working on this at breakneck speed, which is impressive and encouraging. But testing hasn't really happened completely, and there's still big questions about that. But there's a lot of hope about that built into the market right now. There was hopes of the curve flattening. It's clear that that's not happening now, as July has exhibited. There was early optimism about reopenings, and of course these virus spikes have created new initial restrictions, and in some cases partial shutdowns, and some areas of the country are contemplating new bigger shutdowns. And as mentioned before, the big tech companies, those FANG stocks, have really pushed up the market. So that's essentially what is pushing the market up, even if the economy is still in the dregs, so to speak. So I guess one of the messages that we shared some time back, and I always get a kick out of this picture and story, but is to be careful about assuming that things have overstabilized too soon, and being aware of the disconnect between the market and the economy, not necessarily to take action in terms of changing your portfolio, which could affect your long-term plan, but in terms of being prepared for potential volatility so that you can stick with it, so you can prepare yourself and steel yourself against it when it does happen, to the extent that it does. Because there are a lot of talking heads always out there, and people who are really eager to hear positive news and are very happy to hear those that have strong, confident answers about the future. However, there's interesting research that suggests that the greater that people speak with confidence, the greater the degree of overconfidence, so to speak, the more likely they are to be wrong. This picture shows a host from a TV show about stocks, and he is admitting that he blew it in terms of Netflix. And this was 5 or 7 years ago, and has manyfold grown since then. So someone who was very confident in all of his recommendations, but confidence doesn't equal correctness necessarily. So again, let's take a look at what is related to this disconnect, and the hope is that the economy will catch up with the stock market before the reverse happens. But there is a big difference between what's happening in real daily life with jobs and the economy, and what's happening with stocks. And as some would say, this current V-shaped market, if things stretch out with the economy long enough, could turn into more of a U-shape, which would be kind of cooling off and leveling out for a while before it has a more consistent and reliable pattern of increase in growth along with the actual economic change. So because markets are essentially pricing in what you can really think about as a best case scenario, especially if it's not factoring in the second wave in the fall. The PE ratios, which are a measure of valuation, are in the top 10% in the historical range, so theoretically stretched, while the economy is in the top, on the bottom 10% or worse. And that's really shouldn't be ignored. The virus is nowhere near being controlled. Cases are spiking. And one of the interesting things, not too long ago, a couple weeks ago, Dr. Fauci said that a vaccine might be 70% effective, and surveys have shown that 30% of the U.S. population won't use it, even if they believe, or even if experts say that they should. So using probabilistic math, that means less than half would actually get a vaccine, which means there's a very low chance of herd immunity, which is normally considered to be 70 to 90%. So the herd immunity would actually have to rely on actual sickness and recovery. And that's a more painful way to achieve immunity, both from a personal loss and an economic growth standpoint. If cases go where they could, numbers could jump significantly. Some have said into the 100,000 cases per day range, jumping up in the southern states. The US amazingly has 25% of all global cases, but only 4% of the world population. And the US is the only developed country in the top 3, and Florida would rank as 4th if they were a country. So that's a bit of a messy proposition. So far, the summer hasn't really provided the desired or expected or hoped effect in terms of the virus environment, primarily because behavior hasn't changed significantly in a lot of areas, and people relax too quickly personally and in terms of their states. And there's a lot of states that have had that. Maybe you have to admire the human optimism, but sometimes a little too optimistic at our own risk. Another growing potential factor is the increased belief that the virus is transmitted not just primarily by droplets, but by aerosolization, which essentially means that it floats like smoke in the air, if that's the case. And there is increasing research that suggests that that is the case. It's less of a concern if you're outdoors, where the sun has a much greater chance of killing the virus through the ultraviolet light, but really highlights how much more dangerous it is to be indoors, unmasked in public areas where it could float around for a while and for extended periods of exposure. Testing is up significantly since the beginning of the panic, but as cases have jumped, now the problem is people, even if they get testing, aren't getting results back generally for a week, depending on where they are and what the test method is. So a lot can happen in a week if you're in an area where there's a lot of virus exposure. So that means you get the test, you get the result, but you can't necessarily be confident that it's negative if a week has gone by since you heard the result. As part of another example of the level of concern, the Fed has asked banks to cap their dividend payouts, halt buybacks, and to set funds aside. And funds have, big banks and other banks have already set aside billions and billions for what they expect to be a growing number of loan losses, which is really suggesting that they believe the worst is yet to come from an economic standpoint. For example, defaults as one sign of that from companies and loans are in excess of 100 billion so far, which in just this first half of the year is already more than the full year of 2009 after the global financial crisis, which was a financial structural crisis, whereas this is a different scenario and difficult for different reasons. High yield bonds have hit their 10-year high default of 6.2%, so defaults are likely to increase. Savings rates are also high. That's good from a standpoint of people creating a cushion for themselves. However, it does slow the economy if they are not spending. And of course, elections are on the horizon, and there's all kinds of opinions about which direction any given outcome would lead to from a market or economic standpoint. But just another example of uncertainty on the horizon. So, again, with the economy, just a few more details here, and then we'll get to some images. But there's so much news going on each quarter now. I want to whip through some of these things just to give you a sense. So as a reminder, at one point, or kind of at its worst, about a third of the economy was fully shut down, self-imposed shutdown, right? In an attempt to control the virus and control the economic impact. GDP in those first few weeks of the virus ramp up went down about 7% from 2% to -5 in just 3 weeks. That is breakneck speed for GDP. Turns out the annualized number was about -5% in Q1. The second quarter numbers take some time to gather, but it's projected that they'll be about -35%. But again, that's on an annualized basis, so that would be, for example, 7 or 8% or 9% negative, depending on what actually the numbers are, and that's annualized out to somewhere between -30 and 40, depending on the number. What the Fed and others are projecting is approximately a -10% GDP drop for the full year once the whole year is over, but a lot can happen between now and then in either direction. Globally, the GDP forecast is -6% for 2020, but that assumes no second wave of the virus. And experts are pretty convinced that there will be a second wave. Huge federal fiscal stimulus by the government, around $3 trillion, equates to about 14% of GDP. Globally, it's been about 8 trillion or 9% of global GDP. Just enormous numbers. As we talked about before, those are like twice the full amount on an inflation-adjusted basis of the New Deal after the Great Depression. So the scope and scale is just huge. The Fed borrowed to fund most of that, which is expected to lead about 4.5 trillion in total borrowing in 2020, which is about 3 times the total borrowing in 2019. And is likely to lead to the largest annual deficit as a percentage of GDP since World War II. Consumer spending is down significantly, approaching 8%, the biggest decline since 1959. And household incomes fell 2%. Retail sales down 16.4%. Consumer spending down almost 14% during the April lockdowns, both of which were the biggest numbers ever. And retail sales, however, more recently in May have come up 18%, but off of that low, it doesn't even make up for that loss, because losses are worse than gains are good. So one number needs to be bigger than the other for recovery. Consumer spending was also up, but again, still below normal levels. Jobs are one of the biggest elements of this overall story. There was 39 million jobs lost in the first 3 important months. And unemployment rate is declining, but still high. It was almost 15% in April, came down to 13% in May, 11% in June. But there are other numbers that are concerning because the payroll count is coming down, or it's changing more slowly, and the benefits payouts, the number of people who are receiving needing benefits and getting benefits is going down more slowly as well. It's also notable that some of the federal unemployment benefits are scheduled to end at the end of July. So if people don't have their jobs back and are getting less or no unemployment benefits, that could be a concern from an economic stimulation standpoint or lack thereof. So a number of things to consider. Some people, economists, are saying that April will turn out to have been the bottom, which is good that that the bottom is potentially behind us instead of ahead of us. But what's also projected is it's going to be a long, slow crawl out of that hole. Even if the market is up currently, the actual economic recovery could take a while, and some are suggesting that even a decade for full recovery back to normal GDP levels. And all of that said, it's really hard to bet against stocks over any reasonable time frame, especially with bonds at such low yields. And market timing is a matter of luck, not of skill. And so despite all of this sour news, those that have strategies should stick with them. If your situation has changed, it may merit an adjustment. But otherwise, your plans, your design is designed to ride out and incorporate scenarios like this over time. So hopefully that gives you some peace of mind. So let's look at another few numbers about spending and savings here, just to give you a sense. This top chart shows in the gold line e-commerce transactions, which not surprisingly have gone up as people are sheltering in place or staying at home more and shopping out and around less. But the overall spending has dropped down dramatically. Look, this is based on credit card and debit card spending, but which is a growing percentage of the spending tools in general, but was down more than 50% early on, has improved as people have gained a little more confidence, but still at depressed levels. The savings rate has jumped up dramatically, approaching 35%, whereas a more normal level is around 10 on average, or even 5, in the 5 to 10 range. So this is what I was mentioning before about if savings levels stay high and that money piles up and doesn't get injected back into the economy, people may end up building the emergency savings accounts that they never did, that they wish they had a couple months ago, which is a good thing, but that could mean again, more of an impact on economic recovery. It's hard to know which to wish for. In terms of the GDP numbers, this gold line here shows the Fed's estimated GDP numbers, kind of in live data as time progresses. And you can see that currently the projections towards the end of June were at the negative 35% annualized rate. You see the actual really took a hard dip here. And that informs some of this, but this number doesn't necessarily even include the impact of the recent spikes and the increased restrictions and shutdowns. So the trend looks good here, but that trend may has a pretty good chance of cooling off for a little while before it maybe picks up speed a little bit towards the end of the year and get more consistent recovery, hopefully. Then if we look at some of the unemployment numbers under the hood, you can see, hang on a second. For some reason I'm unable to use the pointer, but that's okay. We'll just continue. The unemployment numbers you can see are spiked here. And in the lower left, you can see the unemployment claims have dropped off, but are still significant. So the trend is positive, but it is flattening out, where it was still with a consistent number of claims. The more concerning charts are really the ones on the right, where those receiving benefits have cooled off at a much lesser degree, suggesting that those that are remaining unemployed is significant in the $18 million range. And those that have permanently lost their jobs actually increased despite overall unemployment falling a little bit. So those are some of the numbers to keep a close eye on. This is similar to something we talked about last quarter, but still merits revisiting because it may provide you some strange confidence. So we're coming off up until partway through that first quarter, the beginning of that first quarter, the strongest and longest bull market ever. But even if we were to add on, even if the rest of the year ended up being significantly worse than the current status, so say the market dropped 40%, it would still be an average annualized return of almost 8% over that 12-year period. And that would be above the 7% current projected return and would be almost exactly at the 8% 10-year projected return that was projected 10 years ago. So markets are really, even if they cooled further, wouldn't be that far off the long-term return. So the reason I mentioned the high watermark effect is some people measure their emotions and their concern based on the peak of the market, even if the peak had overshot itself. So it's good to keep that in mind. In terms of where markets stand, you can see on this is from the previous peak through the bottom, some pretty steep negative numbers we talked about before. Diversified portfolios fared better. These are the numbers we talked about last quarter when we were in quarterly context, so some pretty negative numbers there, less so when diversified, but still not nearly as bad partway through that first month of the second quarter. And now, after 2 weeks into the third quarter, relative to the previous peak, despite that huge drop, U.S. stocks are only down 4%, and world stocks are only down 5%. Diversified portfolios, in some cases, are positive or only mildly negative. So that's pretty impressive. Shows a lot of market resilience and maybe a little bit of market optimism. Maybe a little too much optimism. We'll see. So the flattening of the curve, going back to the virus topic, hasn't really happened. This is just an illustration. And the point to make here is that this big curve is what it looks like generally when there's no protective measure. And the key point to make here, when there are attempts to flatten the curve through distancing and through masks, is that it actually takes longer to get through it, but there are fewer deaths because you can manage hospital capacity better. So what's happening now is somewhere in between where there's flattening, but not consistently, and then it picks up. And so let's take a look at what that looks like now. So these are the numbers for the world, US, California, and Florida, Florida being the hottest hotspot, although some are starting to compete for that, at least on a percentage of population basis. And if you look at this dotted line, this is where we were in the conversation at the last quarterly context. It looked and felt like things had leveled out and that we were flattening the curve. You may recall that we showed another chart of past other SARS viruses and where we encourage people not to be overconfident about the flattening because there can be false peaks. And it turns out that that's what we had here. So these false peaks have led to now a bigger peak given the early reopenings and the behavior issues and the potentially much more contagious and aerosolization transmission of the virus. So some pretty big numbers. And this may not even be the second wave. The second wave is more likely to be in December through March period, which is the normal flu season. Typically, the biggest peak is in February, but sometimes it peaks in December, January, or March of the regular flu season. So if you combine, if there's no vaccine or it isn't sufficiently administered and distributed and adopted, and the flu season hits at the same time, that could create some additional challenges. But you might also find this interesting because a lot of the talk in Europe has been about individual countries, but if you add all of them up, they're still not as bad as the US situation. Very similar for a while, but then the approach and the reopenings have been more aggressive here, and the use of masks and distancing has been less disciplined. It's interesting too, because these case numbers are for a population in the US of somewhat over 300 million, whereas Europe is more than twice that population. So adjusted for population, the percentage basis is even more dramatic. So what is the yield curve saying about all of this? Well, you may recall we were talking about a negative yield curve for much of last year, and what that typically implies as implying a economic slowdown, which happened, but not for the normal reasons. It happened because of a virus and a self-imposed shutdown effect. And now the curve is steeper than normal, which means that while interest rates are near zero due to Fed monetary policy, at the short end, they have the difference between those short rates and the long rates are greater than normal, and that's called the steepening of the curve, and that typically implies higher growth expectations, but those are higher growth expectations for GDP, for example, coming off what are expected to be pretty significant lows. So it doesn't mean it's predicting a rapid economic bounce back. So what's next? What's the shape of the economy likely to look like? You've probably heard either here or elsewhere the alphabet soup of the V, U, W, or L-shaped recoveries. The global financial crisis recovery looked a little bit like this. We called it a squiggly square root shaped recovery, which is more like a V, V plus or V something. But it's also important to distinguish, are we talking about the market or are we talking about the economy? So if there's a second wave, one possibility is that this current V shape and kind of sideways in blue here of the stock market, if there's a significant second wave and that leads to job delays or more permanent job losses, that could lead to a recooling of the market until it finds its ground and creates eventually a more consistent increase. That's certainly not a certainty, but some kind of possibility. In terms of the economy versus the market, the economy looks more like this, something we were talking about last quarter, kind of a steep drop, and really is kind of going sideways, hoping to find its ground. The market is predicting that it will, and then before it kind of picks up speed and maybe then stabilizes. So what most economists are hoping and believing is that this will all look more like the Spanish flu recovery, which took a couple of years, versus the Great Depression, which took more like 12. So despite that, and even if markets do get bumpy again, well, it will get bumpy, they are bumpy, but if they get materially more bumpy, or it's just kind of a lot of volatility for a while, it's important to remember that some of the best days, in fact, the biggest chunk of best days come during bad markets. So you don't want to miss out on that. It's tempting sometimes when the market cools to feel like you want to protect yourself, but you may actually be harming yourself by changing your strategy or changing your portfolio in a way that's not consistent with your strategy and your plan. So let's talk more about what matters and what you can control. This provides some peace of mind, just this little framework, a simple Venn diagram, and the things that you can control include the choices that you make every day, being disciplined about your plan, your strategy, saving how much you spend and save, what your business decisions are if you're a business owner or leader, your asset allocation, how you respond to the markets in terms of investor behavior, rebalancing, and of course, physical precautions against the virus. Things that no one can control is the overall virus. We can do things to control it individually, but not globally. Markets, the economy, while we can stimulate it, any given individual can't move that whole needle. Politicians, obviously, and the behavior of others. And the behavior of others is a big deal, not just with the virus, but with markets, because when the market drops, that's a human behavior. That is when there are more sellers than buyers, which, as you may recall, in the last quarterly context, we referred to as a buyer's strike. So just because other people are panicking, that can cause the market to drop. Just remember that the collective wisdom eventually picks up and realizes that the market overshoots on the downside as well. There are more on these topics and others that we've been posting on our blog. I hope you'll take a look. If you haven't, we've been working hard to produce all of our content internally to help support you and give you interesting things to think about that are something other than the kind of below the fray information that's often in the news. We're trying to help stay above the fray and focus on what does matter and things that you can control. So take a peek there and let us know. And if there are topics you'd like us to write about, please send us a note. We really enjoy that kind of feedback and suggestions. Almost lastly here, at least for this first segment, the rules and regulations. We talked about the CARES Act and the impact there and on retirement plans. So I won't go into too much detail since we've covered that last quarter, but it remains relevant. The Paycheck Protection Program still has funds available if you're a business owner or business leader and you have not applied, and if it would be helpful in helping you keep your business thriving and surviving, it's something to look into. And one note from a regulatory standpoint is that the Supreme Court declared that the Consumer Financial Protection Bureau, the power was over-concentrated in the director, and so there's some restructuring there to make that more consistent with what the power structure is deemed to be, or theoretically as it should. We hope that there won't be too many dramatic changes in that structure, because this did prove after the global financial crisis to be a helpful set of tools to protect the end consumer and to discourage excessive risk by and abuse by financial institutions. Won't go into too much detail here, but there were some information about the CARES Act because it came out so fast and so quickly, which was great to help plan participants and others access their funds, which if needed, although that should hopefully be a last resort, because that can obviously harm people's retirement readiness if you're a fiduciary and your plan participants are pulling money out and spending it. But some people really are in dire need, and so this made it easier. So some of the updates clarified how it can be done, extended some of the provisions, making it easier for people to pay back over a longer time period if they want to put it back in the plan. And there are some interesting surveys that came out about how different plan sponsors are using that, so contact us if you'd like to learn more about that. A couple other quick updates. The Department of Labor finalized safe harbor rules around electronic delivery, so that can be helpful, cost saving and simplify for fiduciaries in terms of communications. The DOL also adopted proposed environmental, social, and governance, or what some would call economically targeted, or what previously would be called, in some cases, socially responsible investing, stricter rules around that. So something to keep an eye on if it's of interest to you, not an issue per se if you're an individual, but tighter scrutiny requirements and burden of proof on plan sponsors that you've used a process that actually complies with the law and regulations. The DOL also issued a common sense information letter indicating, essentially confirming that private equity can be used in 401k and other type plans. But functionally, there are a lot of limitations, especially for smaller plans, about that. But we can talk about that later if you're one of our 401k plan clients. Lastly, the DOL also announced its fiduciary rule after a long wait, and in many ways they made it something similar, intentionally similar to the SEC and FINRA's rules around conflicts of interest. But there's still some concerns and exceptions that don't make it foolproof entirely, so consumers still need to be aware. So well, thank you for your thoughts. For those that got the information they needed so far, this is a good time to bow out. Otherwise, we're going to quickly whip through some of our more detailed charts for those that want a few extra details. But we always value your thoughts and your feedback to let us know how we can do better. And it is a pleasure to serve you. So now we'll jump in quickly to some of the detailed charts. Just going to whip through here. This is where we are in the business cycle. Until not too long ago, we were in a late stage. Now we're clearly in a contraction. Volatility has spiked, although it has come down a little bit. It is still at very elevated levels. It's you can see that right there is about the current point. We already talked about unemployment, but inflation remains very low. Although there are some that have concerns about, the question of stagflation, like the 1970s, has been raised. It doesn't seem like it could be on the horizon in the short run. But if the economy is down and there's a problem with supply, that could lead to price inflation and kind of have a double whammy. But not obviously going to happen, but interesting that there's just some discussion about it. Consumer sentiment went through the floor as expected during recent times, and it's come back up a little bit during the second quarter. Oil has been having a tough ride, bouncing back and forth, and OPEC is actually now expecting to increase supply on their projection of increased demand after an initial big dearth of demand as people stopped driving and industry slowed down so much during the last several months. Household debt service ratio remains relatively healthy. The overall non-financial corporate debt is still pretty enormous, and this has implications related to the default rates we talked about before. Household net worth has taken a dip, as you can imagine, due to loss of income and portfolios, etc. And the national debt is one of the big numbers here. So, we're talking about getting up at higher levels than ever at levels, projecting 126% of GDP in 10 years potentially. So that could mean longer term challenges for the economy or the need to increase taxes or cut spending, and neither of those are very attractive options right now. In terms of quality, you can see quality stocks tend to do better in difficult markets. Quality was relatively low for the year, or kind of middle of the ground, backed off a little bit during this more recent quarter. Pardon me, this is really volatility, but the returns for the year and quality on a quarterly measure, the more speculative stocks have picked up more speed as expected, and is often the case in the second quarter. And then markets are hot again temporarily. Cash flows from mutual funds are telling. There's been a huge flow into liquidity, so a lot of people have pulled money out of all kinds of funds, and which has pumped up cash. So that's a sign of undisciplined investor behavior, but we know all of you are sticking with your strategies. Stock valuations are pretty stretched again now for certain segments. So the Russell, the S&P is towards the top. Russell 2000 small cap towards the top. Russell 1000 growth, which is a lot of those big tech stocks, towards the top. So these types of valuation measures usually precede some increase in volatility. So just something to be aware of. And if any of you would ever like to walk through our 5-step process with us in more detail, this is just a reminder of what we do to help you in terms of analyzing, designing, formalizing, implementing, and monitoring, whether it's the planning process, the investment process, spending policy process for foundations and endowments. Similar approach, a structured, process-based approach for all the ways that we help clients. And I won't dwell on this here, but just want to mention interesting summary of studies that you may have seen before that we've distributed in the past, showing that while most studies about investor behavior are about individuals, this set of studies is actually about fiduciaries. So even those that are relatively experienced and sophisticated, there are segments within that group that tend to be less disciplined. And essentially the studies show that replacing an investment manager from a portfolio just because of short-term performance usually leads to a worse long-term return. And again, happy to talk about the dynamics of that some other time or individually. So again, I'd like to do a shout out and a thank you to all those in the economy who are putting their lives on the line to make sure that other citizens and residents are staying healthy and fed. Can't express our appreciation enough. What a selfless effort. So thank you if you or someone you know is involved with that. I would also like to express our support and sentiment for equality of all people. The George Floyd tragedy is not an isolated event, and while there are injustices across all colors, shapes, and sizes, there is a greater concentration of injustices that tends to happen for those that have less power in society, and I think we can all do better. A lot of those concerns are based on fear, some of which is fed or stoked by others in the public realm. Nothing new. This is, that's not a current thing. That's a long-standing problem, and we're stronger together. So we hope you will we'll all do our part to you and we and everyone to make a difference there. Several of us at the advisory group have taken implicit unconscious bias training courses to become more aware. Very interesting. A lot of very small, subtle things that we can all pay attention to just do and be better. So thank you for your time. It's always great to share the advisory group's thoughts and context and perspective with you. And I will now see if there are any questions. So thank you, and stay well and be well and stay healthy.